Buying a foreclosure or any home will never be the same. You need to be aware of the changing lending patterns that are taking place. Banks, mortgage companies, lending institutions, credit unions, they're having to loan money. People have not purchased homes at a rate that they've purchased homes in the past. I'm going to share with you in this episode what you need to do to be prepared to get ready as quickly as possible, because they're talking about lowering the rates. Not only lowering the rates, but the down payment that you have to have. You can purchase a home just like this one, $253,000, 3-bedroom, 2-bath, 2-car garage. For literally, you only need $1,500 a pocket, $1,000 for your deposit, $400 to $500 for a home inspection. You can purchase a house this way. You have to understand that you got to be prepared, but most importantly, you want to make sure that you don't go in the hole financially when it comes to purchasing these properties. So let's jump in, let's take a look. You see, for starters, you have to know a little bit of the history of real estate. And really quick, and I won't bore you with this, but you have to understand from 2009 to 2022, for 13 years, mortgage interest rates never went over 5.25%. So you have all of these people that own a home. 67% of the people that have a mortgage right now have less than a 5.25% rate. However, in 2022, they started raising interest rates, and in 7 months, those rates nearly tripled. They more than doubled. They went from 3% to 7.5%, right at 8%. As a result, it put the brakes on the housing market. Why did it put the brakes on the housing market? Well, for one, people wouldn't put their homes on the market for sale because they had such a lower rate. And two, people wouldn't buy the homes that were on the market because the price of those homes practically doubled. Not so much the price, but the payment. You see, the difference between a $253,000 house at 6.5%, 7% as opposed to 3% is hundreds of dollars on a monthly basis. This is a $253,000 home. You purchase this home today at a 6.5% 30-year amortized fixed rate. Your payment on that's going to run you about $2,100 a month. That same home, and this is going to make you frustrated, I know, but bear with me, because if you rent, you're paying 100%. And I know there's a lot of you out there that are like, I don't want to rent, I want to buy, tell me more. And I'm going to share more of that with you here in just a second, how you can purchase a house just like this with an FHA program and not cost you any money out of the pocket. That's the biggest reason why people can't purchase homes. They make good income, they can get out of debt, they can get their debt down, they can get their credit score up, but they don't have to have tens of thousands of dollars anymore. But here, go with me. You purchase this house at 7%, your mortgage payment's going to run you about $2,200, $2,300 a month. If you purchase that house with a 3%, your mortgage payment's going to be about $1,600 a month. So you can see $500 or $600, and it's not so much people want to pay or don't want to pay. It's bottom line is you can't qualify for that because the home price has actually gone up a little bit, right? They've gone up drastically. Let's face that. But this home right here, purchased brand new, sold for about $120 a square foot. Now these homes are $200 a square foot. It's not so much the price, it's the payment. And that's what's really frustrating, because when they raise the rates, people can't get qualified for homes in their own neighborhoods, their own areas, their own communities. Now, don't get me wrong, there are homes out there. You just go to Google and type in your neighborhood, your area, your community, your zip code. There's homes and there's properties out there. Oftentimes they are fixer-uppers and foreclosures, and for good reason, because there's homes like this that are very much attainable with an FHA loan. However, there's a couple of things on this property I'm going to show you here in just a second that would prevent the home from going and having an FHA loan. And listen, the reason being, FHA comes through and does an appraisal on the property, and there's a difference between an appraisal and a home inspection. You always want to get a home inspection because a home inspector is going to go through and look at every single thing on the home, make sure the stove and the gas and the heat and everything's working. All the appliances are working, everything's in good working order. They're going to look at your breaker panel, they're going to look at your roof, they're going to look at all that. And appraisers, all they're going to do, they're going to look at the bedrooms, the baths, the square footage, comparable properties. They're going to compare your home with the surrounding properties that are comparable to the one you're buying within a 3-mile radius that have closed in the last 6 months. The reason for that is so you're not overspending and the bank's not overlending. Now, a good answer to the question that you need to know, and I'm going to share it with you, is, Wayne, how is this 100% loan? Well, you see, it's an FHA loan. It's Federal Housing Administration, and you can purchase this loan as long as these homes qualify. How do you know these homes qualify? If it's a foreclosure, you got to get out and look at these properties. One way to do that is go to findmyforeclosure.com. When you go to findmyforeclosure.com, it's not free. It's a paid site, but it's going to show you every foreclosure, short sale, bankruptcy, sheriff sale, tax lien sale. You're going to see every single one. If you're an investor, Got to see that, findmyforeclosure.com. If you're just a home buyer and curious, it's about $40 a month. You can see all these properties, get out and poke around. But the difference is they're loaning you the difference in the money and the down payment that you would normally have to come up with. If it's a 97.5% loan, they're loaning you the other 3.5%. So FHA insures the loan for 96.5%, FHA approved lender. The difference is we have lenders that are loaning you the money for the down payment. Now you still have to qualify. You got to have a 600 higher credit score. You got to have 2 years on your job and show proof that you can afford it. And how they know you can afford it is they're going to look at what you have coming in, your gross monthly income before taxes. And then they're going to look at what do you have going out? What is your credit card minimum payments? What is your car note? What is your student loans? Whatever minimum hospital bills, because those are the things that you're still going to have and have to pay after you purchase the home. And they want to make sure that you can still pay them as well as the mortgage after they give it to you. Now, it's important to know that you will have closing costs, but the seller can pay the closing costs. Those closing costs coincidentally run about 3.5% of the loan amount. And since you're getting a 100% loan, it's going to run you 3.5% of the actual loan. As mentioned, you get a 96.5% insured by FHA, and the other 3.5% they're loaning you for the down payment. So you're left with having to pay 3.5%, but the seller can pay that 3.5%, which allows you to purchase a house for literally $1,000 for a deposit and $500 for a home inspection. Now, another quick tip is to know that if you close at the end of a month as opposed to the beginning of a month, so if you close at the end of a month, for example, May 30th, then you won't have a mortgage payment until July 1st. So you don't have to pay a mortgage for 60 days if you close at the end of the month. So let me share with you as we walk through this house. It's in great shape, but you have to understand most homes that are occupied where people have lived in them, you're going to want to do a little paint, a little TLC, and do a little fix up, but I'll share something with you. Look here. See that? That's some rotted wood, and that rotted wood was probably from just a little moisture that simply came through the door. You get that, right? It can easily be fixed, but you also have to look and make sure that it's not termites. I'll also share something else with you. This window right here is broken. And so FHA is looking out for the health and well-being. So that window being broken, it was probably a rock from a weed eater or something that broke that. Now, it's frustrating because you're like, I want to buy this house, I want to make an offer on it, but oftentimes the banks won't make these repairs. They won't fix these items. However, your bank, oftentimes, the lender sometimes, not every bank, but we have lenders that can help you do so, they will write a letter and basically say, hey, it's okay. They can fix this afterwards. We can escrow money. So what that means is the bank doesn't fix it. They're not responsible for fixing it. You can get an FHA loan on this house, not cost you much money out of pocket at all, but you can take your own money, say $150, and fix that. Or better yet, if you got a good agent, they can negotiate for you for the bank to escrow money. That means the bank puts money in the closing attorney's account from them, not you. That way you have that fixed. Once it's fixed, the money comes from the escrow attorney's account and pays the window person. All you did is line up the day and the time for them to come and fix it. Now look, I know a lot of this is a lot to take in, and you're like, Wayne, you make it sound so simple, and there's a lot of moving parts, but most importantly, we try to make it simple in the process. That's why we say, listen, get with a good agent, interview that agent. If you don't want to do that, we do that for you. You can go to contactwayne.com, reach out to us. You can book a call if you want with me or with one of my staff members. We'll call you and walk you through the process. We can qualify you on the phone. It takes about 5 minutes. We're going to ask you questions like, what is your income? What are your debts? Car loans, student loans, medical bills. What do you have going out on a monthly basis? It's important to know they're not looking at electric bill, rent, water, sewer, phone bill. They're not looking at anything that you're paying, because most importantly, once you purchase a home, you're not going to be paying those items. Yeah, sure, you're going to still have your cell phone, but the way they figure that in is, what are you paying right now that once you purchase a home and they give you a loan, you're still going to be paying, such as a credit card payment, a student loan payment, a medical bill, or a car note. Now, as I mentioned, they're going to do an appraisal on the property, and you need to do an inspection. And the reason for the inspection is that way you know that everything's working to its intended function. And if anything's broken, you don't have to purchase the property. It's real important to know that any home that you write a contract to purchase on, whether it be a foreclosure, whether it be an individual property, you're not restricted to purchase that property if you don't want to. If you find something that's broken and not working to its intended function, you can cancel the contract. However, you have to read the fine print, and you have to have a good real estate agent that will explain that to you, that if you do cancel the contract, what are the ramifications? Because every state is different. Some states you can cancel the contract, you get your earnest money deposit back, like Tennessee, Florida, Louisiana, for example, but some states you can't. You lose that deposit. You put up a deposit saying you're going to buy the property, and you can lose your money if you cancel the contract. So you just have to know that going in. But worst case scenario, you're not forced to buy a home that you didn't want, it's not working, and things are broken. But look, it's important that if you do want to buy it, it's quite simply having a list from the home inspector. They're going to give you a full booklet, if you will. They're going to email it to you. It's going to be 140 pages, and they're going to look at absolutely every single thing. But they're going to look for anything that's a fire hazard. Has the home ever flooded? They can see all those signs that the home have termites. They can find that stuff and figure it out. They're going to give you a list of all those items. If you still want to purchase the property, it's just a matter of having that report shown to your real estate agent, because the home inspector is going to give it to you and your real estate agent, looking out for your best interest. And then they're going to negotiate any repairs with the seller. So they can go back to the seller for you and say, hey, still want to purchase the house, but the window's broken, or there's a leaky faucet, or there's some shingles missing. And sometimes people say, well, I don't have the money to fix it, or I don't want to fix it. In that case, if the lender would allow, they can escrow the money, as I'd mentioned, in that window, where it can be fixed after you close on the property. Now, just because you have a home inspector inspect the property, you can still have an HVAC company come out and look at the HVAC and all that stuff, right? But one of the things you want to really look out for is termites. You want to make sure there's no wood destroying termites, carpenter ants, or anything like that, because you want to make sure that a person that's licensed can come out and look at the property. But you have to know that if the home is occupied, they can't see everything. It's always good that the home is under a termite contract. If you're selling your property, it doesn't have to be. If you're buying a home, it doesn't have to be. However, it's a good idea to look around everywhere for termites. I personally have had a couple of homes I've purchased over the years that have had termites. It's not the end of the world. It's things that can be repaired, replaced. I've seen thousands of homes with termite damage. I don't share that with you to frighten you, just to make you aware of what to look for. So you're looking for soft walls, soft spots. Termites typically will start around moist, cool, damp areas where they can eat wood. Now, we talk to a lot of people on a daily basis. Perhaps you're watching this video and you've called in, you booked a call with me, and if you have, I'm forever thankful. Give me a thumbs up, leave a comment, like these videos. It helps us produce and get out more content and more information to help more people. Because I often say, I'm really big on whatever it is you do, your craft in life, you learn it, you master it, and then you teach it and share it with others, and that's what's most important. But you have to know, when you purchase a home this way, this home is $250,000, $253,000. This home in 10 years is going to be worth about $400,000. And if you don't believe me, ask anybody around you, your coworkers, your employer, your mom, your dad, or anybody. They'll tell you, I bought a house for $17,000, or I bought a house. I'll tell you a quick story. Mom and Dad, my parents bought a house in 1987. They paid $55,000 for that home in Nashville, Tennessee. It's a 4-bedroom, 1-bath house on Sheridan Road in Nashville, Tennessee. I just looked up the value of that home yesterday. $412,000 is the value of that home right now today. So you see the pattern. You understand how you purchase real estate and you kind of hold on to it. I know that sounds crazy, because I, like a lot of real estate brokers and agents, we make a living helping people, and we get paid to help people, and that's how we make a living, right? But I can tell you, it's important for you to make a living and you to make a profit. So if you purchase a home, it's good to hang on to it. I'm Wayne Turner. I thank you for watching. I hope you've enjoyed this video. Give us a thumbs up, like it, share it. Until next time, God bless.